Is the euro finally out of the woods as we head into 2023, or will bearish factors actually continue to play a role and exert downward pressure towards parity levels next year? In what range could we expect the euro to trade in 2023? I'm going to answer these questions in this video, but before that, let me remind you to hit the like button below and follow the Capital.com YouTube page. The outbreak of the war in Ukraine was clearly a negative factor for the single currency. We saw the euro weakening strongly after the start of the war in Ukraine, given the negative effects, the negative impacts on higher energy prices and lower consumer and business confidence for the euro area. And then we saw in March, mid-March, the Fed starting hiking interest rates, and that was of course a bullish factor for the dollar and a negative factor for the euro. The ECB announced its first rate hike in July. Only in July 2022, it was the first rate hike after 11 years, but the Fed was already hiking interest rate aggressively at that time, and US interest rates were at 2.5% when the ECB delivered its first 50 basis point hike, bringing the deposit rate to 0% in July. In August, we saw a further weakening of the single currency. The euro broke more decisively below parity levels after European gas prices skyrocketed. There was a stop in the flows from Russia, and the Dutch TTF, the European benchmark for natural gas prices, rose up to 350 euros per megawatt hour. Now, this will be a key theme that we're going to look at with a greater focus shortly. Now, in September, at the end of September, actually, the euro hit June 2022 lows, whole point 95.4. That was the lowest since June 2022, so more than 20 years for the euro. Now, if we look at the drawdown of the euro since the start of the negative downtrend, we are talking about 22% drawdown from May 2021 levels. Now, that's of course a bear market for the euro. At that time, we saw sell-side analysts forecasting a very bleak outlook for the euro, even below 0.90 in 2023. But then something started to change. We saw two consecutive lower than expected CPI prints in the US, and that basically weakened the greenback, because the market started to price in a more dovish Federal Reserve. And we saw also the ECB hiking interest rates by 75 basis points in September, on the 22nd of September, and then also in October another 75 basis points. It will be also important to look at and discuss the latest ECB meeting in December, which, in my opinion, was very hawkish, and because despite a slowdown in the pace of hikes from 75 to 50 basis points, the President Lagarde delivered one of the most hawkish speeches in the ECB history. Now, looking at the relative performance of the single currency since the start of the year, we see a minus 6% against the dollar. The euro lost 4.5% versus the Swiss franc. The performance was broadly flat against the Canadian dollar and the Australian dollar, marginally positive against the New Zealand dollar, and then the euro actually strengthened versus the British pound and the Japanese yen. The euro rose 5% versus sterling and 8% versus the JPY. So these are the year-to-date performance of the. Another key factor affecting the outlook for the single currency in 2023 has to do with the rate policy and the policy stance of the ECB. We saw the ECB hiking interest rates by 50 basis points in December after two consecutive 75 basis points of hikes in the prior two meetings. Now the deposit rate is 2% at the end of 2022. The refinancing rate is at 2.5% and the marginal lending rate at 2.75%. These are the highest levels of ECB interest rates in the euro area since 2008, since the end of 2008. So here we are at the end of 2022, but interest rates in the Eurozone will be hiked further by the ECB next year. And that was what the Lagarde actually signaled in her latest press conference in December. She said that it's obvious that the ECB will continue to hike interest rates consistently by 50 basis points for some time. She hinted that the ECB has more ground to cover compared to the Fed. But let's look at what the market is pricing in terms of ECB interest rates in 2023. Now, if we look at the money market future for the euro short-term rate, we see that the peak is expected to be in September 2023 at 3.45%. Now, since we start from 2%, that implies basically 145, 150 basis points of hikes until the end of the third quarter next year. Interest rates are then expected to broadly remain there or marginally lower by the end of 2023, with the market pricing ECB interest rate in December 2023 at 3.38%. It's also important, of course, to look at what the market is pricing in terms of Fed funds rate in 2023. Now we have the peak in May 2023 at 4.9%. And then the market is pricing almost 50 basis points, around 45 basis points of cuts in the second half of next year. Now that is a little bit in contrast with what the Fed signaled in December, because the latest dot plot of the Fed revealed a median preference for Fed funds rate to stay at 5.1% at the end of 2023. So there is right now there is a disagreement between what the market is pricing in terms of Fed interest rate hikes next year and what actually the Fed thinks about its policy outlook. Let's now take a look at the chart analysis of the euro dollar pair that's the daily time frame. We see the pair currently trading at around 106 level. We are seeing a quite strong 11% rally since the September lows. It's a very remarkable comeback from the bull side of the market here. Now the pair has been able to break above the 50-day moving average first in October and then more strongly in November. There was also a breakout of the 200-day moving average, which was a key technical hurdle for the single currency. There was that breakout in December, so the current price action is trading above the two key moving averages here. Now, if we look at the daily RSI, we saw that in mid-December, the indicator, that's the 14-day RSI, hit hoverboard territory for the first time, actually in more than a year and a half. The last time was in December 2020, so almost 2 years. And but overall, I think despite the strong rally recently in the fourth quarter of the year, we have not yet fully reversed the major downtrend that started in June 2021. Now, if we use the Fibonacci retracement indicator, we see that we have basically, so we're using the Fibonacci indicator of the 2021-2022 low to high range. And so far, we see that there has been a 38.2% retracement of that downtrend from June highs until September lows. So we still haven't retraced half of that trend, and the euro is facing some resistance here. Now, a bullish technical signal could actually be provided by the by a potential golden cross. So-called golden cross happens when basically the 50-day moving average crosses from below to above the 200-day moving average, and we see that the 50-day moving average is rising faster here. Is rising faster than the 200-day moving average, and there could be a crossover soon. Now, this was a positive, I would say, bullish technical signal for the euro back in the end of June. Here there was a golden cross, and the euro experienced a rally thereafter. The same happened in May 2007, another golden cross year, and there was a bullish price momentum in the next 6 months for the euro. Now, let's take now a look at the key levels to watch in 2023. I think that a crucial resistance level is 109. Why 109? We got the 50% Fibonacci retracement level of the 2021-2022 range. We got there also the April resistance, the April 2022 resistance. So what we might expect actually if the euro hits 109 in Q1 next year, for example, if we see a breakout of this major, I think, Fibonacci retracement level, we can see then a potential extension towards 112, which not only corresponds to the 61.8% Fibonacci retracement level, but it's also the level at which the single currency traded prior to the start of the war in Ukraine. So here, the 24th of February 2022, the single currency broke below 112. So that's probably already, in my opinion, one of the most optimistic scenarios for the euro in 2023, reaching 1012. Now, if we look at the downside, as I said, we are already at a key support level provided by the 38.2% Fibonacci retracement. And that's also the level at which the euro traded prior to the ECB December meeting here, 105.8, 106. So to break actually 106 lower, we probably need some unexpected dovish comments from the ECB or more hawkish signals from the Fed that could bring us to test the dynamic support provided by the two key moving averages, which could be located at around 103.5, 103.7. Now, if that level doesn't hold, the next support is 102, which is the 23.6% Fibonacci retracement, and also correspond to the September resistance line. Now, a key question is, of course, many traders and investors are wondering whether the euro-dollar pair could return to parity levels next year, get back to parity levels or lower in 2023. I think we need to see more of the same in terms of energy crisis in Europe, a further widening of the natural gas prices between Europe and the United States, and unexpected rate hikes from the Fed. Now, those could be the triggers that could actually lead the euro-dollar pair to retest parity level. But I think that 0.95, the lows from September 2022, are a little bit too pessimistic to be retested in 2023. We got a firmly hawkish ECB right now. So actually, to revise those level, everything has to literally move to the bearish side once again. A further worsening of the gas crisis in Europe and the war in Ukraine, a disappointment in terms of the magnitude of rate hikes by the ECB, and fresh hawkish hikes from the Federal Reserve. So overall, I think that the pair could trade within 102, 112, so range next year. So a bit of a sideways market for the euro-dollar pair in 2023. To see a bullish breakout above 112, we really need a de-escalation in Ukraine, a solution to the gas crisis in Europe, and probably no recession or a very shallow one in the Eurozone, which will bring us a very hawkish ECB compared to other major central banks. On the other end, for breaking below 102 and retesting parity levels or lower, we need to see a further worsening of the European gas crisis, a weakening economic outlook hitting consumer and business confidence again, and that of course could bring the market to reprice ECB interest rate hikes to the downside. That brings us to the end of our Euro outlook in 2023. I hope you guys enjoyed watching this video. If you haven't already, please subscribe to our YouTube channel and hit the like button below. You can also leave a comment and read our analysis on the Capital.com website. Merry Christmas and Happy New Year to you and your families. Thank you so much.